Hi, this is Cayden from VIA Value Investing Academy. Now, before I start, I want to give credit to ABC News, right, for providing a very good short clip of the American worries about the possible recession after a second straight quarter shrinkage, right, of the GDP. Now, before I start, I just want to double check that all of you can hear me, right, and you are able to see my slides. If you are able to hear me and see my slide, is it okay? Just type 1 so that I'm aware that everything is all okay at your end before we start. Yeah, there are about 66 people of you watching, and then usually over time it's going to increase. Yeah. Okay, while you're typing number 1, so maybe let me just proceed to the next slide. Yeah. Now, I think everybody know who are these two people, right? So can you imagine if you're the President Biden, you're already quite busy, right? We're trying to fix the nation's economy. And then one lady on the left, who is age 82, right? Yeah, visited Taiwan. Yeah, and of course, I'm not very sure right now is China still circling, having their military exercise around the island of Taiwan. So this one I'm not very sure, but I think a couple of days ago they did. Yeah, so one very interesting thing to note is the China actually fired quite a number of missiles across the airspace of Taiwan, right, from one side to the other side. Well, I think this is, in other words, if you're Taiwanese, if you're maybe you're fishing, whatever, suddenly saw one missile fly above your head. Yeah, and of course, all this create uncertainty, right, in addition to the possible recession. So now, of course, the argument based on what you watch in the short clip is US in recession. Now, I mean, it's US, right, but we are Singaporean. I mean, so what, right? Now, if you look at all the past US recession, usually there's a ripple effect. Yeah, so that when US recession, usually about 6 to 12 months later, right, Singapore will be in recession. That's usually the case, which is why as investors, we want to pay attention to what's happening in US. Okay, so very good. Most people can hear and see, right, especially Manfred. Manfred can hear and see 5 times. Now, so previously for many YouTube Live, we've been sharing, all the possible quantitative factors as well as the qualitative factors that may trigger off a recession. And of course, as of today, we are still in a bear market. And bear market is, is defined by a decline, right, of 20% or more from its recent high, and we use the S&P 500 as an indicator. Yep. And just now in that short very clip, it spoke about 2 quarters, right, of negative GDP. Now, if you're seeing this term for the first time, this GDP is gross domestic, right, domestic products. Yeah. So what does it mean? What does it mean, right? So you realize that a country's economy is made up of, let's say, commercial entities, companies, and so on. So can you imagine you add up all the summation, right? Yeah, add up all the summation of the product and services that they provide. They provide in that nation, right? Simply is called a GDP, which means that if a nation is doing well, GDP usually climbs and increase over time. And if the country or the nation is not doing well, usually the GDP will decline. And a textbook definition, which is a recession, right, is when there are 2 quarters of negative GDP growth. So this is a textbook definition. So in other words, if you look at this pop up over here, right, you can see for the first time since 2009, the GDP, right, was negative. That means the last time you saw a technical recession is actually in the global financial crisis period. Was negative for the 2 quarters in a row after dropping this. Yeah, but usually for US to be considered recession officially, it has to be announced by this agency, right, called the Bureau of Economic Analysis. Yeah, but the interesting thing is when you look at the past economic recession, is by the time they announce the recession is really here, or sometimes recession is over. So they're always a month behind. Okay, Yeah, so remember this is a common definition of a recession, a consecutive 2 quarters of reduction, right, in the GDP growth. Yep. And the interesting thing is during that period where there's a global financial crisis, other than this quantitative criteria, right, of the GDP, we can observe that businesses go bankrupt, unemployment was high, and then for property foreclosure, they cannot pay the mortgage and so on, right? Then a formal recession was declared. Yeah, so that was in the global financial crisis 2008-2009, right? Yeah, so I'm going to put here negative growth, right, 2 quarters. So that is to add on to this quantitative factor. But for this time around, it's quite interesting. even though there's a consecutive quarters shrinkage, right, of the GDP growth, and then there's one article, it says, what recession? What are you talking about, right? So US employers add almost 500,000 jobs in July. So it doesn't make sense, you see. So when the GDP shrunk and yet the number of jobs go up, so it doesn't really fit inside the 2008, 2009 global financial crisis criteria. Yeah, but there's always two sides of the coin. You know, here we are, our own very own Prime Minister Lee say outlook for the post-COVID recession could hit within the next 2 years. So you see, there are two sides of the coin, and people are debating whether is there a recession, it's not a recession, and so on. But for normal people like me and you, right, we are not president, we are not prime ministers, and so on. But what matters to us is when we go to the coffee shop, is there a recession at a coffee shop? Not the recession in the nation. So what do I mean by this? Imagine if you go to the coffee shop at breakfast, right? Originally, this is how our wonton noodle looks like, right? And then because of the inflation, it now looks like this. Yeah, then you'll be wondering where's the missing char siu, right? Yeah, so that's called an inflation. Okay, Then not only the char siu is missing, right? You realize that the noodle, the price of noodle goes from $3 to $3.50. So that's a 16.7% increase. Now remember, here we're not talking about the restaurant, right? If you're talking about restaurant and if the government increase the GST from 7 to 9, you know, maybe this wonton also go missing. Okay, Then of course, if we're talking about annual increment, maybe 3% to 5%. So here we have a situation where we personally feel like a personal recession at a coffee shop. Yeah, things become, so here there's like a personal recession, R. Okay, And then here we have a personal inflation, so RI. And then here we have, right, where the annual increment couldn't catch up with our personal inflation and recession. So I think it's quite serious. So regardless of what, you know, whoever on top says, you know, we'll feel it at the ground. So members say, my favorite Western food, raise price from $6.90 to $7.50. Okay, this one is 60 cents. But have you measured the weight of the beef that you ordered? Did it get lighter or not? Yeah, fattier, right? Fattier. Okay. Now, then this is the most recent article. Yeah, income not keeping pace with inflation. Come on, do we need DBS to tell us? Okay, now we don't have to, right? See, DBS study, you know, 4 in 10 people. That's why this guy is crying, you see. So people thought he's crying is for something. He's crying because of the personal inflation and the recession. That's the real reason, right? Yeah. So anyway, right now this guy quite busy. He's been interviewing by many people. Lawrence Wong also posted his picture. Yeah, so he become the face, right? Like the Amber Heard and the who's that? Yeah, who's the other guy? Yeah, Johnny Depp's case now. So right now he has 5 minutes of fame. Okay, now so let's cover it here. But this is a joke. This is a joke. Right? Don't post hating remarks on the video. Yeah, but the key thing is we really feel it. There's inflation. There's like inverted commas. That personal recession. And if you look at this article again, why Singapore's high inflation, right, may drag on to 2023. I mean, without any article telling us, if wonton noodle goes from $3 to $3.50, right, I don't think I have personally, at least 51 years of my life, I don't think I've experienced when this inflation drop, the $3.50 go back to $3. Yeah, so far when things go up, it doesn't come down. It doesn't come down, right? Yeah, so I don't think we need articles to tell us all this. So in short, when they say is sweating, wow, this is quite dangerous to comment. Okay, so in short, high inflation is here to stay. We all know, if you're working adult, you know. So unlikely a bowl of noodles will have more char siu, right? And will decrease in price. Unlikely. Yep. So this is unfortunately the reality that we face. But so what can we do about it? Yeah, what can we do? Now, so moving forward, I mean for VIA, one of the key things for us to encourage all of you is really to invest safely and carefully, right? So of course the next question is, if we have no other choice but to invest, the question is where to invest. Where to invest? Now before we start into the part, right, the nitty-gritty about where to invest, just to let you know that this is our VIA YouTube channel. We have been talking about recession since day one. I think that's about 3 months ago, right? Before the bear market, we talked about a possible market crash, and subsequently the bear market comes. And then we have been talking about many companies, different industry, different sectors to prepare ourselves for a recession if there is any. Yep. And we also talk about some companies, for example, this one we talk about Silgan. This one I think we talk about Tyson Food. And then recently the price of Tyson drop, which is a good sign. And then we talk about various recession-proof industry. Yep. So this is our channel. If you really want to keep up with times, what are the things to invest, how to get started investing, right? Just to let you know, this is our QR code. Yeah. Right now, our subscribers count is about 6.84, right? We just need a bit more to cross over to 7,000. 7,000. So I just need a help to just scan this QR code so that in case if we have any tips for you to learn how to invest, what are the industries that we are looking at, yeah, you'll be the first to notify. Yeah. So I'm going to give you like maybe 10 seconds, right? Yeah. To scan this QR code, a message is going to pop out. You just need to click the subscribe button. And then not only that, if you look at this photo over here, which is me, right? In this very short video, I did talk about one of the company that I really have in my portfolio. Yeah, so what you can do is you can just scan this QR code, subscribe, and then just click on this button, right? And I'll share with you the company's name. Okay, good. 5 seconds to scan, right? 5, 4, 3, 2, 1. Okay, so let's get started. Yeah. So what are the topics that we're going to talk about today? So number one, inflation is here to stay. So that's number one. Second thing is let's talk about recession-proof sectors. Now let's do a quick recap. For the past many weeks or maybe about 1.5 months, right? We have been talking about recession. We're talking about what are 11 sectors. Each sector has many industries and so on. So we enjoy sharing the research that we have. But there are a couple of things I need to let you know, right? So remember, neither My Kinesis Investment Private Limited or VIA, nor Authors, which is me and Hillary, right, are operated or affiliated with any broker, dealer, or licensed financial advisor. So remember, our role is just to educate, it's not to recommend and so on. So remember, right, neither VIA nor me and Hillary makes any representation or warranty as to the completeness or accuracy of the information in the information that we're going to share tonight. So let's move on. This is a recap, right? In the next 5 minutes, I'm just going to talk about a recap. Now, so since we are talking about recession-proof sector, of course, the first question is how many sectors are there? Now, a recap is in total, right, in the US stock market, there are 11 sectors, starting from number 1, which is IT, right, all the way to the last one, 11, which is materials. But even though the 11 sectors they are not evenly distributed because you realize that most of it, right, are in the IT sector, followed by healthcare and so on. So there are many sectors. So of course, if we want to do well, we want to focus on those that really beat the market, which is S&P 500. Yeah, but before that, another recap about the terms, right? Sector, industry, because sometimes people use it interchangeably. But remember that there is a huge difference between a sector and an industry. So let me just go back to here, right? Remember, in the entire US stock market, there are 11 sectors. And each of these 11 sectors has many industries, which means that it is in the form of a Venn diagram, right? Each sector has many industries, many industries. An example would be the healthcare sector. You can see that there are 6 industries. So it further subdivide into many of this. And an interesting thing is at the very beginning, when you watch the ABC News video, the lady, right, who is an economist, she said that of all the sectors, there's only one that appears not to be affected. It's actually the healthcare, which is why tonight, right, we are talking about the healthcare sector and specifically in one industry. Okay, so but let's look at the performance and the reason why we want to like micro, right, and then if we want to look at specific sectors, because ultimately S&P 500, it outperforms I think 90% of professional fund managers given a compounded annual growth rate of about 10.5% per year, right, with dividend reinvested. Now, in summary, right, if you invest in S&P 500, you can actually outwit and outbeat most professional fund managers. But here we're trying to zoom inside, right? Is there any other sector within the S&P 500 that could beat this 10.5? Now, so if we further zoom in, we will be able to see different sectors. But before that, I think I just asked one of my colleagues to play a very short video. But let me share with you the context of this video first. Now, the context of this video, right, is way back in 2002 during Berkshire Hathaway's annual general meeting. Somebody was asking Buffett, right, hey, I want to invest. What are the things that I need to do? So Buffett talks about S&P 500. And then specifically, this guy was asking about, timing, trying to time S&P 500. Do we look at PE and so on? Yep. So after that question, Warren Buffett spent 3 minutes explaining. So just to let you know that even though this video is about 3 minutes, it's very, very precious. Yeah, it's life-changing. So I'll just need my colleague to play this video.
Good morning. My name is Ted Friedman. I'm from Cincinnati, Ohio. You said in the 1996 annual report that most investors will find that the best way to own common stocks is in an index fund that charges minimal fees. 2 questions. First, there are a lot of different index funds that hold different baskets of stocks. What criteria would you use or recommend to select an appropriate index fund? Second, the price-to-earnings ratio of the S&P 500 is significantly higher than its historical average. What benchmark should an investor use in purchasing this index?
Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30-year period, I would pick a fund, and I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field. But I would be very careful about the costs involved because all they're doing for you is buying that index. I think that the people who buy those index funds on average will get better results than the people that buy funds that have higher costs attached to them, because it's just a matter of math. If you have a very high percentage of funds being institutionally managed, and a great many institutions charge a lot of money for doing it and others charge a little, they're going to get very similar gross results but different net results. And I recommend to all of you reading John Bogle's written a couple of books in the last 5 years, and I can't give you the titles, but they're very good books, and anybody investing in funds should read those books before investing, or if you've already invested, you still should read the books, and it's all you need to know really about fund investing. So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do reasonably well over a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time. As to the criteria as to when you should or shouldn't, I don't think there are any great criteria on that. I don't think price-earnings ratio, determines things. I don't think price-book ratios, price-sales ratios. I don't think there's no single metric I can give you, or that anyone else can give you, in my view, that will tell you this is a great time to buy stocks or not to buy stocks or anything of the sort. It just isn't that easy. That's why you go to an index fund, and that's why you buy over a period of time. It isn't that easy. You can't get it by reading a magazine. You can't get it by watching television. You'd love to have something that said, if PEs are 12 or below or some number you buy, and if they're 25 or above you sell. It doesn't work that way. It's a more complex business than that. It couldn't be that easy when you think about it.
Okay, ladies and gentlemen, welcome back. Now, before I start, just to share, there is one question called Yan, right? I sincerely appreciate because you did ask whether do we have a Telegram channel. Now we don't, right? I noticed that for Telegram they can anyhow add people in, so just be careful that VIA or Value Investing Academy does not have any Telegram. Now, so if you want to, if somebody add you into Telegram, it's definitely not us. Yeah. And then, just to let you know that one of my friends shared me a very simple tip, right? In case you are so-called illegally or immorally added to a Telegram group. Now, how do you so-called get out, right? So what he did was he shared on his Facebook post saying that you just need to say, you just constantly spam the group, right? That saying, oh, this is a scam group, this is a scam group. Automatically you do it many times, the admin will kick you out. Yeah, so he told me this is a trick. Oh, I think that's a good trick, huh? Yeah, so got yen that you can do that if you want. But anyway, yeah, we do not have a Telegram group. Thanks for sharing. And in that video, right, that Buffett has shared, remember he shared something about S&P 500 index fund. And somebody asked him, are we supposed to use the PE and so on? So what he's saying is that you need to invest regularly. Okay, so I need my colleague to just put the slide up, right? So in short, the method that he's sharing is called dollar cost averaging. And because Buffett so-called recommended, which is why we use S&P 500, about 10% as a benchmark. And for the past many YouTube Live, we talk about different sectors. One of the sector that we talk about is consumer discretionary, because this 13.4% beat the S&P 500 10%, right? So we have done with this. Check. Now, in case you do not know what I'm talking about, you can go to our YouTube channel and then check through some of our past YouTube Live. And then previously, we have also done the IT sector. Yep, so this one's checked. And specifically, we talk about the semiconductor. Wow, I tell you, this semiconductor is really a difficult one. Because over the National Day, I came across one company. I think it's good, it's undervalued, but my goodness, when I tried to understand the semiconductor, the entire process, wow, it was a nightmare. Because my background is in zoology, right? Can you imagine a zoologist trying to figure out a semiconductor? Wow, I tell you, it's really complex. Yeah. So finally today we talk about something, but at least I understand a bit, which is the healthcare, right? Healthcare. So again, we talk about healthcare because again, it beats the S&P 500. So you realize that by the end of tonight's session, we would have covered all the sectors that have beaten S&P 500. So there's one, there's a one, and this one. So I think of all the YouTube channels, we should be the one that has really covered all this. Yeah, so we are quite proud of ourselves. Yeah, proud of ourselves, right? Just to let you know that for the healthcare sector, right, there are a couple of ETF that mimics the healthcare index. So just to let you know that if you buy one healthcare sector ETF, right, and one of the ETF is called XLV, it simply means that by buying one ETF or by buying one stock, you're actually buying all this company. Yeah, United, Health Group, Johnson & Johnson, and so on. So very good. Buy one stock, you buy, you will have invested in all these companies. So that is a cheap way, right, of investing. Okay, good. But the healthcare sector is very big. There are many industries, so we cannot cover all. So tonight, what we're going to do is we're going to cover one industry, right, within the healthcare sector. And this industry, right, is called the healthcare equipment and supplies industry. And one of the reasons why we do this is because when we talk about equipment and supplies, it's quite physical and tangible, right? So as we explain, we can show you pictures. So it's quite easy for you to understand versus something that is too hocus pocus and too intangible. Yeah. So with that, I'm going to hand over to Hillary, where she's going to go deep dive right into the healthcare equipment and supplies industry.
Hi, good evening everyone. I'm Hillary. So here I'm going to share about this healthcare equipment and supplies industry. So now let's jump right into it. Okay, so first off, we'll look into what is the healthcare sector. So what is healthcare in the first place? Healthcare is a very general term. When I first saw this word, I thought that it could be just hospital, some facilities, healthcare related facilities, or doctors, physicians. But here the definition is that it's actually an organized provision of medical care to individuals or community. So it's mainly sector to provide or treat patients with this curative, preventive, and rehabilitative care, and also to meet health needs of population. So other than treating patients with certain medical conditions, they also provide certain health needs, like for example, mental health, chronic diseases that requires long-term care, and also diabetic. And it's actually made up of 6 industries, which Cayden has showed earlier, which are these 6. So when we look through all these different industries, we kind of we read the term, but we know what it is, but what do they really do? What is it like? What is it really specific about? So later I'll try to explain briefly about what are these industries are about. So first off, we look at the historical performance of this sector. So for healthcare sector, since 2013, it has actually performed better than S&P 500 for the past few years until 2020 when COVID-19, the pandemic struck. So during the COVID pandemic, actually everything collapsed. But afterwards, it actually rebounds back and is performing as good as the S&P 500. And in 2022, when S&P 500 drops, but it actually remains fairly stable. One of the reasons is because people requires healthcare needs and also medical attention. So there is a certain reason why this one is still performing fairly stable at the moment. So now we will also deep dive into what are the industries about. So first off, when you say biotechnology, it's actually more about the genetic analysis and also genetic engineering. And then for healthcare equipments are medical equipments and supplies. Healthcare providers and services are mainly for healthcare facilities like rehabilitation centers, hospitals, or even animal shelters is also considered under this industry. And for healthcare technology, it's actually using technology to innovate and also to make the healthcare practices much more better. And life sciences tools and services is companies that provide analytical tools for hospitals or maybe some research and development companies to do their analysis, and clinical testing services and research services. And for pharmaceuticals, it's very straightforward. It's for producing drugs and vaccines. So these are the general description of these different industries. And the reason why we choose healthcare equipment and supplies, because compared to other industries, it's much more, like Cayden said, it's much more tangible and it's something that we know, and also a lot of healthcare facilities need to use. And when we look at the past performance, it's actually performing better than the S&P 500, which is also the reason why we decided to deep dive into this industry. So now we will look into this industry. So for this industry, it's actually comprised of companies that made to manufacture or supply diagnostic, monitoring, and treatment equipment and supplies. So first off, what is a healthcare equipment? Healthcare equipments are actually devices or machines used for diagnosis and treatment. So diagnostic equipment are something like this, so that the patients can go into the machines to find out if they have any problems with their body without using any surgery. And for treatment is to use these machines to help them to recover from their diseases. And healthcare equipment also includes certain medical devices like these implants, like an artificial knee or maybe a cardiac pacemaker, and also some monitoring devices like this device to monitor the glucose level. So for these equipments, they actually require constant calibration, maintenance, and also user training before using them to make sure that these equipments are in tip-top condition for the health physicians or healthcare providers to use them. And next, because it's called healthcare equipment and supplies, so we also look at healthcare supplies. So healthcare supplies are mainly consumable or disposable medical and surgical items like this medical consumable. So that means after you use it, you just throw it away. So it's a consumable item. And also, some companies also made certain medical apparels for the healthcare personnel, like for example, the scrubs for doctors and also lab coat for researchers. So these supplies are actually being used by the healthcare physicians to treat the patients, like for example, medical gloves or wearing a surgical mask, and then they put on a band-aid on a person's injury, something like that. And now we will also look at the past performance for this healthcare equipment industry. So for this, there's actually one ETF that tracks the performance, which is called XHE. So for XHE, it is comprised of a total of 83 companies for this ETF. And now we will look into the top 10 holdings. So when I first come across all these industries, it sounds very scientific, but I don't know what they are doing at all. So I deep dive into each of them. So maybe I'll list out some of them so you can have a better feel of what are these companies doing. So first off, for Cryoport, it's actually doing a temperature-controlled logistics. It means that it provides temperature control, like a cooling solution for genetic-related analysis. Or maybe they can able to provide other forms of temperature-controlled rooms for scientists, researchers to keep or to store their research materials, like the biomaterials, which require certain temperature to survive. And another one fixed is actually healthcare apparels, like just now what we saw, the scrubs, the lab coats. And these two companies are actually manufacturing body part medical devices for patients that require assistance. Like for example, if the heart is not working well, they can put in a cardiac pacemaker to help the heart work. And also, this company actually manufacture a diabetic monitoring device. So we can see that actually each of the company, they are manufacturing certain specific medical devices for the patients. And when we look back at the chart, we will see that for the past 4 years' performance, this ETF, XHE ETF, has been performing better than the overall healthcare ETF, which is XLV, and also the S&P 500. For this, I choose VOO, which is under the Vanguard ETF. And in 2020, every ETF collapsed. But then, afterwards, after the pandemic, it actually rises faster than compared to the other two ETF. However, for here, the reason for the drop, I've been looking around, but there's no specific explanation. But what I thought of is, because this is a very niche area, so if everything is working fine for this industry, the ETF will increases. But if the industry is not working well, then it will be reflected in this situation. Okay, now we will look at the future trend or the potential growth of the industry, because when we invest, other than we know the historical performance, we wanted to know how far will this industry go. And the past performance does not really reflect the future performance of the industry. So first off, in this article, it says that the medical equipment sourcing will spike as the healthcare industry booms. Why? And also, in this research, they also shows that the medical device market will increase from 2021 until 2030 for 850 billion US dollar. But why is it so? Why will the medical device market increase along with the healthcare industry booms? It's because first off, it's the demographic. As people are growing older, they will require more medical care. And when we look at this chart, since 1950, the chart has been slowly increasing until 2060. And different regions of the world, the population are actually increasing for the age over 65. And then the second one is because there's the rise of Internet of Medical Things. Earlier on, we saw that the overall S&P 500, the information technology took up about almost a quarter of the S&P 500. So right now, the world is slowly moving towards the digital, and this includes healthcare. So what is actually Internet of Medical Things? In short, it's that every healthcare-related healthcare data that will be uploaded onto the cloud so that it's easily accessible by the healthcare physicians. So you can see from this chart, this is one of the main data source so that they can easily access and also analyze the data. And here, they actually says that with the Internet of Medical Things, it can improve the diagnosis and treatment, because you can see with these devices, the doctors, the physicians, they can easily see what is the conditions of the patients. Last time, if the patients have some issue, they might need to do some biopsies and then take some time to analyze the cells before they can decide what is the issue that the patient is facing. But here, with these devices, they can easily just put them inside to an MRI scan and then see what is the problem with the patient. Then they can do a specific diagnosis based on the patient's condition. And also, they are able to provide a remote monitoring of chronic diseases, because imagine if a patient requires a long-term care, but they need to stay long-term into the hospital because they require constant monitoring by the healthcare professions. They will take up a hospital bed, a hospital space where another patient with acute syndrome might need. So it's kind of like, how should they juggle between the spaces? But with this technology, they are able to go back home and take care of their long-term diseases. Like, for example, right now, all of us are using like Fitbits, and also like the Apple devices where they can track our health conditions or how many steps we are walking. And also this, recently, we've done a YouTube live on Teledoc, which is a telemedicine. So if you're interested about telemedicine, you can check back to our past YouTube live to learn more about Teledoc. And now we will look into the companies within these industries. So right now, this is a simplified explanation on the healthcare supply chain for this industry. So for the manufacturing devices company, they are actually belong under to manufacturer. So once they have manufactured the products, then these are actually their customers. That means the hospitals, clinics, and also the patients are also part of their customers. Okay, so here in this chart, it actually shows that the top 10 medical devices. Earlier on, I showed you about the top 10 holdings within the XHE ETF, but when I was doing the research, currently these companies are not performing as good as per this top 10 revenue. But why are these top 10 companies having the highest revenue? Later we will see what are the products that they are producing, and you'll be able to know that the reason why they are able to generate a lot of revenue. So I actually categorize them into 3 different types. So these first 3 actually produces mainly about medical devices. And then these 3, they are producing medical devices or healthcare related products under certain segment, and they have other business segment within the company. And for this company, it's actually providing a kidney dialysis service or kidney related products. And then for this company, it's actually providing medical and surgical supplies. So here are some of the companies that I listed out, which is Medtronic. So for this company, it manufactures medical devices, imaging systems, and diabetic monitoring systems. So you can see that it's really purely about medical devices and equipments. And then for Abbott Laboratories, they also produce these few products. And BD is actually long name called Becton Dickinson and Company. So these are the products that they produce. And finally, Stryker. So when I look at Stryker, initially I thought it's like an army related, because when I was looking through the company, I saw some of the images, they are actually showing army tanks or something, but it's actually a medical device company. So they actually produce the implant products and also some surgical equipments. So from here, the list that you can see, these are really they are really focusing on manufacturing medical devices, but with different range of products. And for this one, J&J, it's a commonly known household name. So they actually have 3 business segments. So these are the 3 different business segments. So they are not only focusing on producing or manufacturing medical devices, they also focus on pharmaceuticals and also consumer health, like for example, powder talcum, or maybe shampoos, baby shampoos, something like that. And for Philips, usually when I saw Philips, my first thought is electronic products. But surprisingly, they have different business segments which are under here. And it has a segment that also produce diagnosis and treatment equipments. And for GE Healthcare, it's actually one of the branch from GE, which is General Electric. So under this General Electric Healthcare, there are 4 different business segments. It's inclusive of aviation, healthcare, renewable energy, and power. And also Siemens Healthineers, they also have 4 business segments, and these are the business segments that was being listed out. And I think that I picked up the wrong company icon, GE Healthcare. So it should be General Electric, and General Healthcare is actually belong under one of the business segments. Okay, so now we will look into the financial comparisons among these few companies. So first, we will compare the top 10 revenue generation companies. And first, PE ratio is actually means that for the price that we pay for the share, how much earnings or profit is the company generating. So if it's less than 16, it means that the company is cheap or it's undervalued. So here I've highlighted at least 2 which is below 16, which is Fresenius and also Corning Liske Philips. Is actually the long name for Philips. And then net margin is actually means how much percentage of the profit is being generated by the company. So the higher the percentage, it means that the company is more profitable. So here I highlighted the top 3 high net margin percentage, which is Philips, Johnson & Johnson, and also Abbott Laboratories. And for price to operating cash flow, it means that for the price that we pay per share, how much cash flow is the company able to generate? And for this, the lower the better. That means the lower it's cheaper to purchase the company. And here I also highlighted out the 3 companies that has the lowest price to operating cash flow, which is General Electric, and also Fresenius Medical Care, and also Philips. And finally, we also curious that how do they manage their debt. So we look into debt to equity ratio. So based on the value investing methodology, if the debt to equity ratio is below 0.5, it means that the company is able to manage the debt well. So here I highlighted out the companies that has less than 0.5 of debt to equity ratio, which is Medtronic, Siemens Healthineers, J&J, and Abbott Laboratories. So from here, we also see how many points they are able to accumulate. And currently, Philips is taking the lead. So here you can take a screenshot. And also, this is just a preliminary screening to see which company is performing well based on these criteria. It does not mean that which company is good to buy at the moment. If you wanted to know which company is good to buy at the moment, later Cayden will share with you how you can decide whether the company is good, cheap to buy. And now we will also look into the competitive mode and efficiency. So for competitive mode, we wanted to know that is there any business advantage edge that the company has over their competitors. So with this, we will look into the difference between ROIC and also WACC. ROIC is return on invested capital, and WACC is weighted average cost of capital. So if we only look at these two numbers individually, it does not mean anything. We only look at the difference between these two. So the bigger the difference, it means that they may have some certain type of quantitative advantage or moat for the company. So here we see that I pick out the top 3 biggest difference companies for this, which is Cardinal Health, Johnson & Johnson, and also Abbott Laboratories. Next, we wanted to know whether is the management able to generate returns using the equities and assets. That means are the management being efficient using the equity and asset to generate profits. So for ROE, which is return on earnings, based on value investing methodology, if it's more than 15%, it means that the management are doing a good job utilizing the equity. And ROA is return on assets. If it's more than 7%, that means it is considered a good condition based on value investing methodology. So here I also highlighted the top 3, the companies that is performing more than 15% for ROE and more than 7% for ROA. And now we tabulate all the points that each company accumulate. And now we will see that currently it's Philips, J&J, and Abbott that's leading the tie. So here you can also take a screenshot for your reference. Okay, now we are also curious that since the industry looks okay, looks good, but is there any potential risk within this industry? So first off, is a supply chain disruption. Because if there's anything wrong with the supply chain, they cannot manufacture the products, then, like for example, there's device shortages, they cannot provide the products to their customers, then the hospitals, the physicians, they won't be able to use the equipment or the medical supplies to treat their patients. And one of the supply chain disruption is that there's a limit use of sterilization substance. What does this actually mean? Because in US, they are starting to crack down on the use of substance. And because most of these medical devices and also supplies require sterilization to make sure that it's safe before the physicians can use them. But because the substance that they use is actually ethylene oxide, a kind of chemical which will lead to a higher cancer risk. And this leads to certain device shortages within the industry. And next is hurdles in Internet of Medical Things. Because right now, everything is slowly moving towards the internet side, the digital side. But if let's say there's this kind of hurdles like the cybersecurity breach or energy crisis or power outage, which will disrupt the workflow, it will definitely put a slowdown in the advancement of this industry. Okay, so first off, cybersecurity breach is that currently it hits an all-time high. Why is this considered a risk? It's because there are some hackers, they will hack and also try to get the personal health information and sell it on the dark web. So we know that each of our personal informations are very sensitive. So imagine your health informations or healthcare data as being sold on the dark web. you can imagine how impactful is, how detrimental is the situation is for that person, because this type of data is our personal, our own sensitive data. So we would like to keep it as private as possible. And also currently, because of the Ukraine war, the Russia and Ukraine war, especially in Europe, is having a lot of energy crisis. And it was due to the shortages of fuel that leads to energy crisis. So when there's energy crisis or power outages, the devices cannot work. When the devices cannot work, then the doctors cannot use the device to help and treat the patients. And lastly, declining human population. Earlier on, I've shared about there was an increasing amount of old people are getting older, more than age 65, but because, okay, now from this chart, we see that since 1950, there was a sudden increment in the human population was because of baby boomers. But then over here, at the start of 20 to 50, we see that the human population is slowly getting plateau. It's because the fertility rate, that means the babies are getting born, is dropping. And from here, we see that since 2019, every mother can only give birth to one baby. So imagine that even though the human population is increasing in an exponential rate, but if the mothers are only giving birth to one baby per family, then the population will start to dropping. One of the examples that we can see is based on China, the one-child policy. Earlier on, they have this policy is because they don't want the population to grow too fast. But since the start of this policy, right now, China is slowly facing about the population is starting to slowing down. And currently, I learned that the recent news is that right now they are trying to increasing the population by allowing parents to give birth to more babies. And we also see at this chart, it also shows that different regions throughout the world, the fertility rate is actually declining. Even though right now the population is quite high, and it may remain about 10.9 billion by the year of 2100, but if people are not giving birth to more babies, then the human population will slowly plateau and even may decline in near future. Okay, so to conclude all for this industry is that we see that there's a potential growth of the medical devices within the industry in the Internet of Medical and Technology. And also, there's a rise in remote monitoring or the telemedicine, because with this, the patients can stay at home and they can have access to the doctors at home. And also another thing about this is that the cons for this industry is that if the healthcare data is being hacked by hackers, then people will be wary to use these devices. And also the supply disruption will affect the productions of these medical devices. So with that, I've briefly explained about this industry, and I hope that you have gained more information about this industry and learn more about it. So I'll pass this back to Cayden, and thank you everyone.
Okay, welcome back. Now, before I start, let's do some recap, right? Recap, because there's one question. Let me just pull a live chat. Yep. So, okay, there is a question, right? First one, I think maybe let me just answer the question about from Easy, right? EZI, EZI. Just to let you know that he specifically talked about a United Healthcare Group. So United Healthcare Group is under one of the 11 sectors, and the sector is the health care sector. And remember, right, under the healthcare sector, there are many industries. And just to let you know that sometimes healthcare companies, they do a lot of things. Yep. So I think I'm just guessing, right? His specific question is, okay, so right now I know that it's under the healthcare sector. Under this healthcare sector, there are many in the industry. So which industry does it in? So I just found one. Yeah, so managed healthcare insurance. Yeah, so I think it depends on which website you go to. There's a couple of classification. So one of them they told me is managed healthcare insurance. Then another one they call it diversified healthcare services. Yeah, diversified healthcare services. So in other words, if there is a diversified healthcare services, then this United Healthcare Group, right, ticker UNH is under here. Okay. Yeah, so that's, I hope they have addressed your questions. Okay, so let's come back here. Now, just to let you know that because there are 11 sectors, each of the sectors is really huge. There's so much things to describe. So for Hillary, she has no other choice. She just had to pick one, which is the medical services. Now, if you look at the slide that I'm showing here, in all different sectors, they have all pros and cons. They have their risks, they have the advantage and so on. So as investors, our role is to have less wrong, right, and more rights. Yep. So these are the pros, these are the cons. And just to let you know that one of the interesting trends in the healthcare, right, is this telemedicine. And if I remember correctly, I think it's 1 month or 2 months ago, we did talk about one company called Teladoc. Teladoc, as the name implies, is being like, you can split it in 2 words. Right? One is tele, right, which is a telephone, right, and the other one you can use a telephone to talk to doctors. So Teladoc. This company is highly regarded by Kathy Wood, right? But I'm going to stay away because the company is not doing well. So remember, if an influencer or TikToker, right, keep talking about this company, I think it's important for us to really pay attention. What is it talking about? So pros and cons. So what I'm going to do is I'm going to wrap what Hillary has said in just a couple of slides. Now, investing, it can be easy provided you know what's happening. Now, if you don't know, right, it's actually quite difficult. And because if to you it's difficult, you don't understand, it can be quite risky. Now, if you look at this diagram over here, right, this one shows the healthcare ETF. Remember, right, S&P 500 has 11 sectors. Yeah, recap, and we purposely chose one that exceed 5%. Exceed 5%. So one of them is this healthcare equipment ETF. So what does it mean? It simply means that if stock picking, right, picking one company is really too much. I mean, all the technical terms, accounting and so on, right? So what you can do is you can explore buying a basket of companies, and this healthcare ETF consists of a basket of healthcare companies, and if you look at the return, right, and we use benchmark a VOO, right, V over here, right, I think this line, yeah, sometimes color code is a bit tricky, So if you look at here, right, can you see this XHE on top, right? Blue is the darker blue, right? Yeah, it's doing better than this. Also this one, right? Yeah, so now you can buy like one ETF rather than individual stocks. Yeah, if individual company is a bit too much for you. So Andre say, who is Kathy Wood? She's always in news. Very good. She's always in news to sell her ETF. Yeah, otherwise nobody buy her ETF. Right? Now remember, fund managers, they make money from the commission. So they make money from a percentage of their asset under management, which is AUM. So her role is to promote. Correct. So that if you put money with her, she make money out of you. So let's come back to here, right? A good question. Yeah. And then of course, that single ETF has 83 companies. Remember, you buy one ETF, you buy a whole basket of this company. So that's one way that you can buy a huge group of companies, which is what Buffett was saying. Yeah. But Buffett, of course, specifically say S&P 500, right? And just now, for Hillary, she also specifically talked about some of the top 10 medical devices company in the world. Now, the one that, you know what, I would have heard like Johnson & Johnson, Abbott, all this. But the interesting thing is when I was much younger, right, yeah, I thought that Johnson & Johnson only sell baby powder. Baby powder. So you realize that Johnson & Johnson is really the second largest medical device company in the world. Also, they don't just sell simple things that you found at Sheng Siong or CK, right? Yeah, see, okay, so this is very interesting. And of course, Hillary has give some quick review, right? Give you some of the numbers and so on. Okay, so that's what Hillary has said. Now, so what I'm going to talk about next is I'm going to talk about a specific company. But I purposely withhold the information, right? What's the company's name? What's the ticker symbol? Because I don't want, our sharing. And then after that, the next thing we know is you go and press buy. Yeah, so I think it's quite dangerous. Quite dangerous. But I give you a very brief, right? What does this US company do? Which is again under the healthcare sector, since we're talking about healthcare sector, right? Now, so just to let you know, this company is a big company. In Singapore context, we can call it a blue chip company. Yeah? So what do, right? They discover, they develop, and they commercialize products, right, that fight eye diseases, cardiovascular, that means heart-related disease, right? Cancer, I'm a cancer survivor, so I would know, as well as inflammation. Yeah, so this is a very brief description of this company. But remember, right, if we want to make money, we don't want to lose money. This is too simple. We have to really deep dive, go and dig inside, talk about what a company is, and you can watch our past video, right, where we do some case study analysis of some US companies. Yeah, you can use that as a framework. But let me just come back to here, right? Now, before I carry on, I think it's important that investing, right, requires some form of knowledge. And if you look at this quote that's shared by Buffett, right, Buffett say that, you have to understand accounting. Now, he didn't say that you have to be an accountant, but you have to understand accounting. And you have to understand, right, the nuances of accounting. In other words, you have to understand the language of money, okay? So remember, right, it's the language of business and it's an imperfect language, but in short, this one, unless you're willing to put in effort, right, to learn accounting. Remember, it's learn not to become an accountant, right? Which means that you need to read. Yeah, if you hate to read, then a bit difficult, huh? You must understand what it means, the numbers, what it means. You shouldn't be selecting stocks yourself. And the reason why I want to talk about this, this simple quote I said by Buffett, right? Because nowadays, at least from my social circle of friends who didn't learn investing, right? They buy stocks by watching a YouTube video. Yeah, this is quite dangerous. This is quite dangerous. Right? For example, they watch a 5 minutes YouTube video and the person is an influencer, TikToker or whatever. Then suddenly the next thing you know is they whack 10K into the stock. You mean you put 10K into something that you base on an influencer's video? I think that's quite dangerous, right? So in other stock itself is not dangerous. It's the person, right, who's handling the 10K that is dangerous. So we have to be very careful. Now, so in the next 10 minutes, I'm going to share with you the fundamentals, right, of this a healthcare company that I'm going to talk about, and I'm going to introduce some terms in the simplest way. Yeah, and you need to understand some of the terms that I talk about so that you won't like gonna scam, or in case some people talk about some company, you need to check the numbers. You can check the numbers yourself. And if you are holding some stocks, right, I think it's important for you to understand the numbers, right? Yeah, numbers. So there is one question, maybe later Hillary can help to reply, right? So that I can focus on what I need to do. Now, so this is the pharmaceutical company. Yeah, and of course, assuming that you understand the company and so on, the first number, right, that we want to look at is this number called a revenue. Yeah. So of course, from a business perspective, business revenue, right, that means revenue is like our salary. Every month we work, we have a salary, right? Yeah. So this is the revenue. Yeah. They sell things, they got revenue. They sell products, they got revenue. So of course, from a business perspective or from a value investing perspective, we want, right, the revenue to go up. Okay, number one, we want it to be an uptrend. And second thing, right, we want it to be positive. Okay, so in this case, this healthcare company, right, met these two criteria, uptrend and then positive. So it's a pass. It's a pass. But remember, right, revenue is the salary. But before I carry on, have you read articles where some people make like 10K, 20K, right? But they are broke at the end of the month. Yeah, so what does it mean, right? It simply means that, yeah, you make 10K, make 20K per month. It sounds quite big deal, right? But the bigger deal is how much is left after you've gotten the salary. Salary, right? Yeah. So the company is the same thing. Revenue was so nice, right? But remember, now I'm going to introduce this like so-called like a meme, right? A meme phrase. Remember, right? Revenue is vanity. So when somebody say make 10K, don't be too happy. The most important thing is how much the person has, right, at the end of the month. So revenue is vanity, and the other one is profit is sanity. So let me share with you the net income, right, or rather the profit and loss of the company. So in other words, if this for net income, right, or profit or loss, of course, we want it to be positive, right? Because positive, that means it's profitable. Negative, that means it's loss. So in this case, not only is positive, right, it's uptrend. So based on value investing, it's considered a pass. Obviously, we want the company to be profitable and then getting more and more profitable, right? So I purposely draw a zero line over here so that you can see that this line over here is positive. Yeah. So remember, yeah, whatever, next time when you watch a YouTube, you have to go and check, okay, can you please tell me what's the revenue? But not 1 year, but the whole series of past 10 years. And next one, what is the profit? Because revenue is vanity, profit is sanity. Okay? Yeah, then we need to look at more numbers. So at least for this session, you know what's revenue, what is profit and loss, right? Which is net income. But that's not all. No. Now, just to let you know that on the 24th of November 2021, myself and Hillary, we did one company called Palantir. And we wanted to do this company because we're very curious, because there's some influencer TikToker, right, encourage their followers, right, there are hundreds of thousands of followers. Oh, you must buy this company called Palantir. So we're very curious, because Warren Buffett didn't talk about this company, but this influencer talked about this company, right? So we are very curious. So we wanted to figure out what is Palantir, and I have no idea, until I did my research. So what we did is for this video, which is at our YouTube channel, we talk about what exactly Palantir is doing, how does it make money, who are its customer, what's the business model, does it make money? So you realize that we really go deep dive and then understand, does it make money? Okay, so let's look at, we're going to look at the revenue, but before that, remember, the video that we did, right, which is actually a YouTube live, was done on the 24th of November 2021, and we highlight to our viewers that you must be very careful about this stock, right? Because this company is not making money yet. Now, in future, will they make money? We are not sure, but it's not making money yet. Now, at this point, we only know that it's not making money. Whether the share price go up and down, we are not sure. But if the company is not making money and has not been making money, right, I think there is no rationale on why the price should go up. Yeah, does it make sense? So remember, at this point in time, we have no idea where the share price will go, right? So that is on the 24th of November 2021, but we highlight to our viewers that, just take note of this company, right? Be careful, Now, so the first thing we shared with the audience is, let's look at the company's revenue. So revenue, is it positive? Yes. Yeah, is it uptrend? Yes. Pass. But remember, right, revenue is vanity. Vanity. What we want to know is after they draw the salary at the end of the month, right, are there some money left? Now, so let's look at the Palantir's net income, which is the profit and loss. Now, this is the zero line, right? This is the zero line. You may notice that since the beginning of time, since IPO, right? Yeah, IPO, it has never made any money yet, Yet, right? So in other words, if Palantir has not made money yet, it's quite difficult to justify why the share price should continue to go up, right? Yeah, go up, Now, so remember, profit is sanity, So let's look at this company, right? Now, Palantir shares fell more than 14% following earnings report, right? Yeah. Why, right? Recently, this is very recent. So here, Palantir reported second quarter results that showed a loss per share compared with the projection. So in other words, they project make money, but eventually they lose money. Yeah. So So remember, earnings per share is lost money, right? Versus what they expect. Right? So remember, November we highlight this, right? So eventually, what happens today? As of this afternoon, right, the share price has dropped from its most recent high of $28 to this afternoon share price of $9. So that is the 67.6% drop. So what does it mean, right? What does it mean? Imagine if you buy here. If you buy here, in order for you to break even, don't say make money, right? Break even, right? Yeah, break even, the price that you have bought has to increase by 208.8% rise. Yeah, correct, So it's very important for us to invest in a company where, yes, the revenue goes up, which is a vanity, right? But the profit also needs to go up. Otherwise, it's quite hard to support the share price for it to go up. So, of course, because the company is losing money, naturally people you lose money. I think I better dump stocks, which is why the share price keeps dropping. So remember, the person who bought here really is going to suffer. Suffer, right? Yeah. So to break even, you really have to do your prayers. Do your prayers, right? So that's only one company that exists in the social media, right? So remember, during any bull market, everybody is a genius. So be very careful, right? So remember, the best way to get out of trouble is to stay out of trouble. So that's one company that influencer talk about, right? Yeah. Now, so the second company is, I saw one YouTube ad, right, where there's two gentlemen saying that, hey, this company called C, right, a global consumer internet company, is a super stock. Yeah, so the ad was running for many months until when the share price dropped, the ad disappeared. Okay, so is C really a super stock? Remember, just now we have learned the term called revenue, right? So let's look at the revenue. Whoa, the revenue looks quite fantastic. It's like exponential, right? Yeah. So does it meet the positive sign? Yes, definitely, right? So this is the zero line, Does it go up? Yes. So it appears like a pass. Remember, revenue is vanity. So let's look at the profit and loss. Now, this is the zero line. So what happens to the profit? Now, number one, there's no profit. But what happened to the loss? The loss is getting greater and greater, more and more negative, right? Yeah, so now we have to ask ourselves, if you look at this, would you put your hard-earned savings of 50K, 100K, right, into a stock because two gentlemen say this is a super stock? Yeah, we have to think very carefully, right? So remember, profit is sanity. Now here we're not talking about making money yet. Here we are just saying that following Buffett's advice, by understanding terms, right, such as revenue, such as net income, which is another term for profit and loss, that will save us our savings, and that can be a lot. Okay, that can be a lot. So remember, now then the interesting thing is on the 27th of July 2022, right? Somebody, right, called Trevor, right, wrote an article for Motley Fool, and then he say buy the dip. Wow, my goodness, buy the dip. And one of the company they recommended is C Limited, which is a S. Yeah, so remember this just a couple of days ago, no? After the share price has plunged a lot, now he wrote an article, right, saying buy the dip. So the first question is, I'm curious, right? Did Trevor bought this stock? Did he buy the dip? Yeah. So sometimes they write something, but they themselves don't do it. So you have to be very careful, huh? So remember, right? Everybody is saying whatever they want to say. Buy the dip, buy this, buy that. This is a super stock, this and that. But the money belongs to us, so I think we must be sensible enough before we dump our hard-earned money into something, right? We have to understand that something properly. Buying a laptop, you want to understand what laptop, right? Buying a refrigerator, you want to buy a refrigerator, right? You cannot see one article, buy the dip, then you quickly buy the dip. So it's quite dangerous, huh? Now, so let's look at this C again. Now, remember, the company is losing money, right? Yep. So the net income is falling, but the share price is going up. Now, so there is hardly any logic, right? How can this price be sustainable? Now, bearing in mind that during this period, until here, right, it's a bull run. It's a bull market. So any stock, even company lose money, the price keeps going up. Then when a bear comes, right, can you see? Yeah, investors who bought here realize that, alamak, I think it's a dumb idea to buy a company that's losing money. So they start selling, right? Yeah. Now, I just want to share with you that if this C continue to lose money, right, I think you can be rest assured that the price may fall even further. So which means that if you buy here, right, I think it's going to have a hard time. So what does it mean, right? Is it a super stock? You have to ask yourself. And then you look at this share price, remember, if you buy here, what does it mean, right? The share price will have dropped 77%. And then in order for you just to break even today, right, the stock that you hold right now has to go up by 339%. Alamak, this is going to be... I think it's going to be quite difficult, quite difficult, right? Yeah, so be very careful, So two terms, we must understand revenue, we must understand net income. And remember, right, revenue is a vanity, a profit is sanity. So let's come back to here. So here, same thing, positive, 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 right? I think there's some question, right? So maybe I need Hillary to reply, right? Yeah, so that I can focus on this, So positive, positive, revenue goes up. So based on value investing is a pass, right? Yeah. So remember, revenue is vanity, which is why we want to talk about the profit, right? Profit, right? So positive, positive, this one goes up, So this is a pass based on value investing criteria. But remember, right, revenue profit is the money that comes in. Now, we also want to look at other criteria. So we've learned two, right? Revenue, net income, right? So we also want to focus on this cash flow from operation. That means every single day, every single quarter, every single year, when they sell their services and their product, right, overall, are cash coming in or overall are cash going out. So if it's positive, overall cash is coming in. If negative, cash is going out. So obviously, we want to see cash coming in. So you can see, right, most of our numbers, other than this number, most of our numbers are positive and it's uptrend. Here, exponential, right, goes up. Yep, so this one is a pass. But for me, in real life, I want to know whether is this a one-off. So that's a bit side note. But let's come back here. So you want to see positive and then uptrend, so it's a pass. So that's a cash flow from operation. And then the second thing, right, we want to look at this thing called the free cash flow. So what is this free cash flow? Free cash flow, that means after I have sold all the pharmaceutical equipments, products, and so on, so the cash come in. So if I take the cash and then I minus away, right, something called capital expenditure. That means money that used to buy equipments and so on. Are there any cash that are left, that are freely available, right, for the company to use? So in other words, if there are cash that is freely available for the company to use, that so-called cash flow, right, is called free cash flow, freely available to use. And of course, we want it to be positive, we want it to be an uptrend, and this is considered a pass, free cash flow. Revenue pass, net income pass, operating cash flow pass, free cash flow pass. Yeah, but just to let you know, there are many criteria. So we're just showing you a couple of criteria so that in case people say buy this, buy that, you know what are the criteria to check off. Now, the next criteria we are looking at is called a debt to equity ratio. If you're non-financial term, I think this is quite challenging. Now, so what does this mean, right? Debt to equity ratio, that means debt on top and then equity at the bottom. Yeah. And we want it preferably to be less than 50%. 50%. So what does 50% mean? So in other words, if I translate this 50% to a fraction, right, is 50, right, divided by 100. Yeah, which means that for every $100 of capital that I put in a business, I cannot borrow, right, more than $50. So in this case, the recent one is 0.14, right? 0.14 is 14 divided by 100. Yeah, which is less than 0.5, which is good, Which means that for every $100 of capital that they inject into the company, right, they only borrow $14. So that's good. Now imagine if the debt to equity is 2. 2, that means 200 divided by 100. Wow, that's quite scary, because they inject 100 but they borrow 200. Yep. So you want it to be less than 0.5. So this one, in this case, not only 0.5, it has declined over time and then right now stable somewhere about 0.2. So it's a good sign. Yeah. So overall, right, what do we have? We expect revenue to go up. For this company, check, yes. We want net income or profit to go up. For this company, yes, check. Third one, right? Does the cash flow come in or go out? The cash flow come in, yeah, for 10 years. Pass, check. Now, number 4, right? How about the free cash flow? Yeah, free cash flow. Free cash flow, pass, check. So 4 check already. And then just now we introduced this ratio called debt to equity ratio, right? Debt to equity ratio, we want it to less than 0.5. Yeah, so pass, check. Now, so before I carry on, just to let you know that this video is permanently recorded in this YouTube link, right? Please feel free to share with your friends. Now, just to let you know that investing, there are really many criteria, but at least for this evening, right, because your time is quite precious, so I shared 5 basic criteria, yeah, for you to form a checklist, right? So in case any influencer say buy this, you check through. Wow, like cannot make it, cannot make it, So if you cannot make it, I think don't put your hard-earned money in, regardless of how people say it. Yeah, because ultimately when something happens, right, you cannot hold a person accountable. Yeah. So for those people who invested in Palantir or invested in C, I mean, I really hope that eventually the company turn around, they do well, and then eventually the share price go up, and then at least you can break even. So remember, the best way to get out of trouble is to stay out of trouble. If you're unsure of some things, please go ahead, please skip, right? Now, so let's assuming that there are 10 criteria, 20 criteria, and you check over, everything looks really nice. Now, the next stage, right, of investing is to ask ourselves, is the company undervalued? Because you don't want to overpay, right, for a company. Yeah. So in this case, the black line over here, right, represents the intrinsic value of this healthcare company that I've shared just a moment ago, right? And this blue line is the current price. So what does it mean? Now, if the share price is below the intrinsic value, we say that the company is undervalued. This is what Warren Buffett would do. Warren Buffett would buy undervalued, right? Now, if the share price is hovering around this black line over here, right, is fair value. Fair value is also a buy, except that if you buy a fair value, usually your gain will not be a lot. So as much as you can, you want to buy undervalued. Then the next one, right, is above this intrinsic value is called overvalue. Yeah, so if you have the stock, you bought it when it's undervalued, then here is a sell. But if you don't have a stock right now, it's overvalued, then it's a hold. That you cannot do anything because it's too expensive. So remember, there are 2 stages. Number 1, we want to make sure that the company's fundamental is good, not because of somebody say it's good, right? It's because we have done our homework. Then the next one, we are only interested in buying the business provided it's undervalued or provided is fair value. Okay, so with that, I'm just going to end the session. I would like to thank myself, own self, right? I also want to thank Hillary. Hillary did most of the work, especially the technical part, right? And also our teammate Irfan and Susie, who are dealing with all these cameras, the lights, and so on. And of course, Alex is at the back end, right, trying to answer the question, help with the subscription. So just a small little event like this, which is about 2 hours, there's a 5-head count, right? 5-head count to make sure that all things are okay. Okay, so Wendy, right? Yeah, until the next deep dive or the next gathering, so we shall see you, I think it should be 1 or 2 weeks later. So with that, remember this Cayden from VIA Value Investing Academy. Stay Stay safe, right? And I shall see you inside our subscription portal. Okay, goodbye.